On January 30th, silver crashed over 20% in a matter of hours. But here's what doesn't make sense. While futures traders were panic selling at $95 an ounce, sovereign mints around the world were suspending sales because they ran out of inventory. Dealers were charging $130 for metal officially quoted at $95, and buyers couldn't get physical silver at any price. So, which market is telling the truth? Let's start with what actually happened. Between 9:30 and 10:25 a.m. Eastern Time on Friday, January 30th, 2026, silver futures experienced one of the most violent sell-offs in recent history. Silver dropped from $121 to $95. Gold fell from $5,600 to $4,150. Volume spiked to 81,000 contracts during the peak window, well above normal levels. Stop-loss orders cascaded. Leveraged positions were liquidated. The CME raised margin requirements to $32,500 per contract, forcing traders to either post more cash or sell. Google searches for sell silver tripled that day. On the surface, this looked like a classic blow-off top, the bull market hitting a wall, panic capitulation. But while paper prices were collapsing on screens, something completely different was happening in the real world. Stay with me, because this divergence matters more than the price action itself. Here's what most people don't understand. There are two silver markets operating at the same time, and they don't always agree. The paper market is where futures contracts, ETFs, and derivatives trade electronically. Billions of dollars move every day. Hedge funds, banks, institutional players. Most of these contracts settle in cash. Nobody takes delivery. It's just numbers on a screen. The physical market is where actual coins and bars change hands. This is sovereign mints, refineries, bullion dealers, retail investors who want to hold the metal in their hands. In theory, these two markets should stay aligned. The paper price should reflect what the physical metal is actually worth. But during extreme stress, like January 30th, that alignment breaks. And when it breaks, you get something most investors have never seen before. While silver was crashing to $95 on futures exchanges, this is what was happening in the physical world. The Perth Mint, one of the world's largest sovereign mints, located in Australia, one of the biggest silver-producing countries on Earth, paused wholesale orders for its 2026 kangaroo silver coin. The reason? Increasing worldwide demand and a large backlog of orders. The pause was scheduled to last until late February. Monthly allocations were implemented to ensure fair distribution across regions. Think about that for a second. Australia produces massive amounts of silver. Their government mint can't keep up with demand, and this happened during a price crash. The U.S. Mint suspended certain numismatic silver products. The 2026 American Silver Eagle release was delayed to late February. Advanced subscriptions sold out immediately. The Royal Mint in the UK ran out of stock on 1 kilogram silver bars, one of the most common investment formats. In India, one of the largest silver markets in the world, dealers reported delayed deliveries and order cancellations even after payments had been accepted. This wasn't a local problem. This was happening simultaneously across multiple continents, multiple sovereign mints, multiple major dealer networks. This next part matters. When mints can't keep silver in stock during a price crash, it tells you the crash wasn't driven by real supply and demand. It was driven by financial liquidation in the futures market. But the physical market, that's a different story. Now let's talk about what China did. On January 1st, 2026, exactly 1 month before the crash, China implemented strict export licensing requirements for silver. They reclassified it as a strategic material, same category as rare earth elements, same category as resources deemed critical to national security. This move cut an estimated 60-70% of global refined silver exports from China. Let that sink in. The world's largest silver exporter just restricted supply by 2/3. And while they're restricting exports, reports indicate ongoing withdrawals from silver vaults in Shanghai, metal flowing out of exchange warehouses into private storage. China isn't just limiting supply to the West, they're accumulating. Why? Because silver isn't just a precious metal anymore. It's an industrial commodity with no substitute for certain applications. Solar panels, electric vehicles, advanced electronics, 5G infrastructure. China is expanding production in all of these industries, and every single one of them requires silver. So they're locking down supply while the West is panic selling futures contracts. That's not a coincidence. That's strategy. Here's where the paper-physical divide becomes impossible to ignore. In a normal market correction, when spot prices fall, physical premiums compress. Sometimes they turn into discounts. Buyers step back. Dealers lower prices to move inventory. That's not what happened on January 30th. Premiums expanded. Dealers in India and China were charging $10 to $20 per ounce above the crashing paper spot price for immediate delivery. In some international markets, premiums hit 40-60% over spot. Do the math. Paper price says $95. Physical buyers are paying $130 to $150. That's not a market imbalance. That's a market where the futures price is disconnected from reality. Major online bullion dealers reported order volumes spiking 500% during and immediately after the crash. Processing delays extended into weeks. When demand surges while spot prices are falling, it tells you one thing. Informed buyers are trying to convert low paper prices into tangible assets before the arbitrage window closes, because they know something most retail traders don't. Let's talk about the elephant in the room. The COMEX, the exchange where silver futures trade, operates on a fractional reserve system. As of mid-January 2026, COMEX registered silver stock stood at approximately 113 million ounces. That's the metal actually available for delivery against futures contracts. Now here's the problem. Open interest in the March 2026 silver contract alone represents approximately 528 million ounces of exposure, 528 million ounces of paper claims, 113 million ounces of actual metal. That's a ratio of 4.7 paper claims for every ounce of deliverable silver. The first notice day for the March contract is February 27th. If even 30% of March contract holders stand for physical delivery, meaning they demand actual silver instead of cash settlement, COMEX would need to source 150 to 160 million ounces. Current registered inventory can't support that. So what happens? 3 scenarios. Scenario 1, COMEX invokes force majeure or changes contract terms to prevent large-scale physical delivery. March longs get paid in cash at the crashed spot price. The system survives, but credibility erodes, and physical buyers recognize that paper claims are unreliable during stress. Scenario 2, the January 30th crash succeeds in scaring enough people away. Delivery demands drop to levels COMEX can manage from existing inventory. This requires retail buyers to stay away and industrial consumers to accept cash settlement. Scenario 3, delivery demands exceed available inventory even after the crash. COMEX either experiences delivery failures or is forced to source metal at prices significantly above the crashed paper price to fulfill contracts. The fractional reserve structure becomes undeniable, and price discovery shifts toward the physical market. Which scenario unfolds depends entirely on how March contract holders respond. If they capitulate and close positions, scenarios 1 or 2 happen. But if they recognize the arbitrage opportunity and demand physical delivery to immediately resell at elevated physical premiums, scenario 3 becomes very likely. This is the part almost nobody is talking about. There's another indicator most people aren't watching: silver lease rates. Under normal conditions, silver lease rates hover around 0.3–0.5% annually. That's the cost to borrow physical silver for short-term needs. In recent weeks, lease rates have spiked into the 8 to 16% range. Some sources report even higher levels in specific markets. What does that mean? Elevated lease rates indicate that physical silver is scarce enough that lenders demand substantial premiums to temporarily part with their metal. This is not the behavior of a market with abundant supply. This is the behavior of a market where deliverable metal is in high demand and holders are reluctant to lend without significant compensation. If silver were truly in surplus, if the January 30th crash reflected genuine oversupply, lease rates would be falling, not spiking. But they're not falling, they're rising. Here's the structural problem nobody's addressing. The global silver market has operated in a supply deficit for 5 consecutive years. Every year since 2021, total demand has exceeded total mine production by hundreds of millions of ounces. The cumulative shortfall over this period is estimated to exceed 800 million ounces. That deficit has been filled by drawing down above-ground stockpiles accumulated in prior decades. Vaults have been drained. Inventory buffers have been depleted. The slack in the system has largely disappeared. Industrial demand alone has surged. Solar photovoltaic installations are consuming an estimated 230+ million ounces annually. Add electric vehicles, data centers, 5G infrastructure. All of these industries require silver, and there's no substitute for many of these applications. So when a market runs cumulative deficits for half a decade while simultaneously experiencing surging industrial demand and geopolitical supply restrictions, eventual price adjustments become structurally likely, regardless of short-term paper market volatility. History doesn't repeat, but it rhymes. In 1979 and 1980, during the Hunt Brothers silver squeeze, similar dynamics unfolded. Paper and physical markets diverged. Dealers ran out of inventory. Premiums exploded. Buyers couldn't source metal even as prices were moving. Eventually, the paper price was forced to adjust upward to reflect physical scarcity. Silver surged from roughly $6 per ounce to $50 in a matter of months, one of the most dramatic commodity rallies in modern history. Today's market is different in structure, regulation, and participants. Circuit breakers and position limits exist that didn't in 1980. But the fundamental principle remains. Paper markets can suppress prices temporarily through leverage and liquidation, but they cannot create physical metal. When physical supply cannot meet physical demand, price must eventually adjust. Now let's be clear about what could go wrong. The January 30th crash could be the start of a longer correction. Macro conditions could deteriorate, central banks could tighten policy, industrial demand could slow. It's also possible that delivery demands on COMEX stay low enough to avoid a supply crisis. Cash settlements could dominate. The fractional reserve system could hold together for another cycle. And there's always the risk that regulatory changes, emergency measures, or force majeure clauses get invoked to prevent defaults. These are real risks, and anyone holding physical silver or futures contracts needs to understand them. But here's the counterpoint. Those risks don't change the 5-year cumulative deficit. They don't restore COMEX inventory to comfortable levels. They don't reverse China's export controls. And they don't eliminate the structural industrial demand consuming silver faster than mines can produce it. The January 30th crash may have shaken out weak hands. It may have provided a short-term reprieve for a stressed futures market. But it didn't resolve the underlying imbalance. And that imbalance is still there. So what does this mean for you? If you're holding physical silver, the January 30th crash is largely noise. Sovereign mints can't keep it in stock. Dealers are charging premiums 40 to 60% over spot. Industrial buyers are willing to pay significantly above quoted prices to secure supply. The paper price and the value of the metal itself are increasingly disconnected. If you're trading futures or ETFs, volatility is real. Margin calls are real. Liquidations are real. You need to understand which market you're actually exposed to. And if you're watching from the sidelines, the question you need to ask is this. When paper and physical markets tell two completely different stories about the same asset, which one do you believe? I want to hear from you. Drop a comment below with your price target for silver by the end of 2026. Are you buying the dip, holding, staying out entirely? And if this analysis helped you understand what's really happening in the silver market, hit that subscribe button. We're covering developments in real time as the March delivery deadline approaches, because this story is far from over.